I'm going to start off with Mr. Ayodiji Ebo. I would like you to talk to us about the state of the power sector.
If we, before looking at the current state, they are looking at the value chains that which is involved in the power sector, from the gas generation, gas supply, the GenCos, which is generation. And you also look at the distribution before you now come to the TC, and there are different sectors. But what the government have tried to do is to, last year, to try to privatize the GenCos and the DISCOs, which have been supported mostly by the bank. But currently, we've begun to see some form of challenges that have continued to parade the banks. When you look at some of the loans which have been launched to these banks, most of them have not, the cash flow have not been coming forth, which we feel that government needs to first of all sort out the gas supply, which will guarantee that the GenCos are generating sufficient capacity. Currently, based on the capacity, is about 4,000, operating capacity is about 4,000 megawatts, compared to the installed capacity of about 10,000 megawatts. So we expect that if government needs to get that at the end of the gas supply, right, such that the GenCos can supply enough, and also in terms of what the DISCOs who are not able to get enough inflow, cash flow, because of the metering system, which have not been gotten right for now. If that is not done, we don't think that there may be much progress that may be made concerning this power sector privatization. And that is why for now we've seen that government, the banks which have discovered that most of these loans, based on the projection, are not coming forth like what was projected. The government is coming up, just came up with about 213 billion naira intervention fund for the GenCos, which will be used to clear out some of the backlogs. And based on the conditions that have been assigned to some of those before they can access those loans, they have listed that there must be metering, it must be used to purchase equipment. And when you also look at the DISCOs, the amount that also been is over 100 billion. If all these are put in place before they can be able to, most of the banks can also help the NIPP, which needs about $8.5 billion. Most banks would develop cold feet in learning to this space if nothing is done about this sector.
Let me come to Oju Demizwe. What's your own take on the power sector?
Talking about the state of the sector, we all know that the sector has been having all kinds of challenges, operating at a very horrible level of capacity. Nigeria has had that problem over the decades, where power supply has been epileptic, at best, and that has been the state over the years. And government has been worried, have been in this process of privatizing this sector for more than a decade now. So for me, looking at where we're coming from, we are a nation of 170 million people and having somewhere between 3,000 to 4,000 watts, megawatts of electricity, where, ordinarily the global standard is 1 megawatt per 1,000 people, meaning that Nigeria should have at least 170,000 megawatts of electricity. But let's not even go theoretical. We have all agreed that if we can have up to 40,000 megawatts, it's enough to power the economy to an extent where our growth will be so quantum, so massive, compared to what we see now. So the sector has not been doing well at all. And that has slowed so many things down in the economy. In fact, for me, getting it right in this sector is a single most important step we must make in this country to improve our productivity and improve the chances of prosperity in this economy. The sector is holding down so many things. SMB development cannot move forward because of this sector. Economic growth is slowed down because of this. Attracting foreign direct investment is also a big problem because any investor must come in with his own power generating set. So that makes it a lot difficult to attract FDI. So there are several issues with the sector. And that's why I think the federal government, tried to do the much they could to push through the privatization process. They almost hurried it to make sure, nothing became an obstacle again. Okay, but having done that, issues that came from that hurried process are beginning to come up. vis-a-vis, talking about now the outstanding debts, like, Ayo has mentioned. A lot of debts, legacy, what I've called legacy debt from, the PHCN, the Power Holding Company of Nigeria, prior to November 1, 2013, when the provisional exercise was deemed to have been completed. And then that debt is so massive that the new asset owners of these companies are almost benumbed. They can't do anything, until these issues are resolved.
Okay,
So,
we'll come back to the issue of this debt in the course of this conversation. But let me come to Ayodeji, and I want us to look at the issue of the challenges of funding for the power sector. These banks are beginning to be owed again. We saw what happened in the banking sector, where AMCON had to step in to bail out some banks because of bad debts. Yeah. That's even one issue. Now, and that's actually another one. But let's look at the fact that there's been a challenge of having access to funding. The banks have complained that most of the cash flow or cash reserve have been sterilized by the central bank. 75% of public sector deposits has been saved with the central bank. We have 15% of private sector deposits. Now, how would you describe the challenges of having to fund the power sector in all?
Yeah, firstly, even if the bank have more funds to earmark for this particular sector, we need to ask ourselves, when you look at the documentation of some of these assets that will be sold, some of these challenges which we spoke about earlier, have they been resolved? About $4 billion, which we know that is mostly Nigerian banks that have supported that made the success of the Gencos and the Discos, made it successful. How have they been able to recoup from the cash flow payment of the past debt, even if they say they want to, the banks wish to mobilize more funds to that particular space. So, firstly, we also wonder why the foreign banks have not also been supporting. What we've seen is providing technical assistance, which they know that their funds are not committed. It means that maybe in the process of the due diligence that have been done, it's not sufficient enough for the foreign banks to disburse to support even the banks. ADB has set aside about $500 billion, which has not been assessed because of the conditions that have been attached. So the banks should not be quick to raise any issue of tying it to the sterilization of the cash reserve ratio, which is currently, especially for the public sector, is currently at 75%. They should see how they can be able to manage and see how the loans that have been disbursed to the banks, how disbursed to the Gencos and Discos, how to be performing. UBA disbursed about $700 million. How is this loan performing? How has the repayment been made? Has it been reducing? And how is the cash flow been coming? Before we talk about even loaning more funds. With the new fund that even the federal government has set aside, there are some stringent conditions that are attached to it. So we need to first of all answer some of those questions before we can even disburse more loans to that particular space.
Okay, let me come to Orji. You talked about legacy debts while we were discussing earlier on. I just want us to look at the fact that the banks are having some kind of issues with having to, use short-term funds for long-term projects. Now, could that be responsible for this debt that is beginning to mount in the power sector?
No, the legacy debt I spoke about were debts owed by the Gencos and Discos to the gas supply companies. Okay, these are operating debts they accrued in course of their operations, which they were incapable of paying. Okay, so now we're talking about how can the new owners of these assets move forward with their supply of sufficient gas for their operations. So it's a case where, yes, these assets have been privatized. We have got new and how do I put it, interested owners that will need to move forward to the next stage, but they are not able to get the necessary supplies of input resources that enable them operate. Okay, and then even, when we're talking about funding, Balaji, the issues are multifaceted. What are we going to be funding? Are we going to be funding, providing fund to offset the existing liabilities of this company? Of course, we know, just like we have AMCOM, we also have NEMCO, what they called Nigerian Electricity Liabilities Management Company, which is meant to be how do I put it now, the twin sister to AMCOM in the electricity industry. They are meant to take over all those liabilities and create some kind of bonds, backing them up, so that these new companies can take off on a fresh note and be able to pay back these debts over time. But how well has that happened? So we're looking at, are we going to be funding these liabilities? Will you be funding the refurbishment of existing assets which are almost moribund? Are you going to be funding new assets to be able to create increased capacity? Because the capacity we have currently is not enough, even if we stretch it to the full capacity. So there are issues. So for banks, they're looking at what areas can they play active part in. Okay, of course, we know that banks will not go and be paying a backlog of debts that existed before these new owners took over these assets. So banks' focus is more like how can they ensure sustainable gas supply to these companies, and how can they help them bring in new equipment like we mentioned earlier, the transformers and other technology that are required to drive the new process. That's a concern for banks. And like you mentioned earlier, banks are also struggling on their own. With the CRR that has stifled loanable funds, with the post-crisis issues that banks have been having to deal with, and then the Basel III concerns too. Banks are also trying to shore up their capital to be able to meet up with the Basel III requirement, which is catching up very soon. So there are challenges, and of course the fact that the funds available in the Nigerian financial system are typically short-tenured, and to use these short-tenured funds to finance long-term assets like the power sector assets is a huge challenge. So banks have to look at all kinds of initiatives, taking senior debt, development finance institutions, funds. IFC have been helping, but how much can they give based on our capacity to be able to support these projects?
Okay, Ayodeji, you're talking about having to sell bonds to be able to raise funds to finance the power sector. We've heard and read about stories that banks are going to the international market to sell dollar-denominated bonds and euro bonds. What does that say to you?
Yes, they are trying to, what we feel most of the assets which they are selling in dollars, and they are trying to avoid any currency mismatch. But currently, based on available statistics, about over $2 billion have been raised. I think it's over $3 billion have been raised from through Eurobond. But we feel some of the banks that that are trying to even raise this fund are trying to still cover up some of the existing dollar-denominated loans, so which we feel are not performing. So, but when you also look at in terms of the cash flow, the revenue, Nigerians that pay we pay in naira. So if there's any exchange rate volatility, some of these banks will also be exposed. There's a form of currency mismatch when the cash flow comes in naira. And you have to convert to dollars before you also pay back this loan. So we see they've discovered that based on the current interest rates in the low interest rate in the US, it presents them opportunities. But we feel that that window very soon, in view of the winding down of the of tapering in the US, will close that window such that they need to now come and look inwards. And if the dollar-denominated loans are not performing, they may not be able to raise more dollar-denominated loan to cover up for the existing one. So it's form of a bit challenge, but the major reason why we feel that is driving most of the loans is for them to be able to take advantage of the dollar-denominated loan in both the power and the oil sector. Oji spoke about Basel III that the banks will need to adopt. Basel III favors more of Tier 1 capital. So it's also another challenge for some of the banks that have a lot of Tier 2 capital. So there's a cap to the amount of Tier 2 capital that can be raised. And that is why you will notice now most of the banks are coming out to raise equity, which is Tier 1 capital, through rights issue, so that they are able to meet up with the requirement. Currently, based on the CBNS, systemically important banks, CAR, that's capital adequacy ratio, should be around 16% for them. So for some of them, which they are just about 200 basis points above the 16% requirement. is going to pose a big challenge for them. So they need to, we will continue to see increased tier 1 capital raising for them to show up their capital so that they are able to meet up with the regulatory requirement, the Basel III requirements, and they are not found wanting when that starts up.